Welcome to the Deep Dive, where we cut through the earnings call noise to get you the insights that actually matter.
Great to be here.
Today, we're jumping into Caleres Inc.'s second quarter 2025 earnings call.
Yeah, this one was definitely interesting. A lot going on.
It really felt like a case study, didn't it? Trying to balance those tariff headwinds, a maybe cautious consumer, and then this big pivot into luxury.
Exactly. It's quite the high wire act they're attempting.
Yeah.
We'll see if their strategic footwork is, agile enough.
Okay, let's unpack the headline numbers first. Caleres Q2, what did we see?
Well, adjusted earnings per share, the EPS, came in at $0.35.
Hey, okay, the consensus was expecting, what, 756 cents?
Yeah, exactly. So a pretty significant miss there, about 38%. Really stood out.
Definitely caught my eye. What about the top line, the revenue?
Revenue was $658.5 million. That actually narrowly beat the consensus of $656.5 million.
Oh, interesting. So a slight beat on revenue, but a big miss on EPS.
Right. And that revenue figure was still down 3.6% compared to last year.
Okay. And margins, gross margin.
Consolidated gross margin landed at 43.4%. That's down 210 basis points year over year. So pressure there.
Significant pressure. And SG&A, selling, general, and admin expenses.
Those were up, came in at 41.0% of sales. That's an increase of 170 basis points compared to last year.
Oof. So costs up, gross margin down, big EPS miss, despite a tiny revenue beat. How did the market take it?
Not well. Predictably, I guess. The reaction was pretty clear concern. Shares dropped notably during and after the call.
Yeah, I saw that. Elevated volume too, and some options activity suggesting maybe downside hedging.
That's right. It really shows, despite that slight revenue beat, the market just zeroed right in on the profitability miss, the EPS miss, and that margin compression.
It really highlights the sensitivity, doesn't it, to operational efficiency, especially now.
Absolutely. I mean, in this environment, a bottom line miss, particularly one that big, it just overshadows almost everything else. The whole story shifted immediately.
From holding revenue to where did the profit go?
Exactly.
Okay, so let's dig into that. Why? Why the big pressure on gross margin specifically? What's the real story there?
Well, the main driver, the primary culprit, was tariffs. About a $10 million impact from new tariffs.
$10 million just from tariffs.
Yeah, and that hit the brand portfolio's gross margin specifically by around 250 basis points.
Wow.
And beyond just the cost, tariffs force this big rethink of supply chains, right? Especially in footwear, which has been so concentrated geographically.
So it's not just a quarterly hit. It could be pushing longer term, maybe expensive changes?
Could be. Are they signaling a real structural shift in sourcing or just, tactical moves for now? Hard to say definitively yet. They did also mention some selective promotions.
Oh, okay.
And higher markdown reserves. Seems like they had some excess spring inventory to clear.
So tariffs plus maybe some inventory hangover. And speaking of promotions, they mentioned Famous Footwear too, right?
They did. Famous Footwear's gross margin was hit by having more days on promotion. And specifically, a deeper BOGO buy one, get one offer than they ran last year.
That sounds like a tough lever to pull repeatedly. Does it get better?
They think so. They anticipate less of a headwind from that specific BOGO shift in Q3 and Q4 because they'll basically anniversary it. Yeah. They'll be comparing against the period last year when they already had it.
Right. The comparison gets easier.
But, the question is, will just anniversarying that be enough? Enough to offset maybe other pressures like ongoing tariffs or if the consumer gets even more cautious for the holidays?
Yeah, that's the key risk, isn't it? Mitigating a past issue doesn't guarantee smooth sailing ahead.
Exactly. It avoids the double hit, but the underlying pressure might still be there.
Okay, so those are the headwinds. But Caleres wasn't just playing defense, right? They made some pretty big strategic moves. Let's talk about the acquisition.
Right, Stuart Weitzman. That was a big one. They closed that just after the quarter ended, August 4th.
And they're calling it a new lead brand.
Correct. This is a major strategic shift. It aligns with their focus on premium brands, direct-to-consumer, and growing internationally. Stuart Weitzman obviously ticks all those boxes with its luxury positioning and global presence.
How did they fund that?
They amended their ABL, their asset-based lending revolver, expanded it up to $700 million.
Okay.
And it has an accordion feature up to $950 million.
An accordion, what does that mean exactly?
It basically means they have the option, if needed, to increase the borrowing capacity up to that $950 million limit. So it gives them a lot of flexibility, extra liquidity cushion.
Got it. So the integration is happening now. What are the expectations?
Yep, underway. They expect immediate expense synergies, things like distribution, logistics, maybe pooling media buys.
Makes sense.
The goal is for Stuart Weitzman to actually add to earnings, be accretive in 2026. So there's a transition period through January 2026 first.
That makes sense. But it's a bit of a challenge, right? Integrating a luxury brand like that while also running Famous Footwear. How do you keep the brand cachet?
That is the delicate balance. Maintain the premium identity, find the operational efficiencies, but don't dilute what makes Stuart Weitzman special. It's a strategic tightrope, like you said.
Definitely one to watch. Okay, besides the acquisition, what about cost management? Were they addressing that?
Oh yeah, aggressively. They finished a structural cost savings program expected to deliver $15 million in annualized savings.
15 million, okay.
And about half of that should hit this year. Plus, they brought in consultants to review their entire cost structure.
Really? So looking for more?
Seems like it. They're anticipating more structural savings in 2026 and beyond. It shows a real commitment to discipline, controlling what you can control when the outside world is choppy.
Absolutely. That makes a lot of sense in this kind of environment. Okay, let's break down the performance of the two main segments then. Famous Footwear first. How did they actually do in Q2?
Famous Footwear saw total sales decline 4.9%. Comparable sales were down 3.4% for the quarter.
Okay, down. But any signs of life?
Yes, actually. And this is key. The trend improved through the quarter. July was only down 1%, and then August actually flipped positive. Positive 1% comp growth in August.
Oh, wow. August turned positive. What drove that?
They said increased traffic and conversion in their physical stores,
Yep.
also better online traffic with higher average selling prices. And a big factor was the exclusive launch of the Jordan brand.
Ah, Jordan, that's huge for back to school.
Absolutely. They said it quickly became a top 10 brand for them for back to school. They also gained some market share overall in shoe chains, and specifically in the kids category. Kids penetration hit 21%.
Interesting. And what about those flare store formats they talk about?
Still performing well, generating about a 3-point sales lift overall compared to non-flare stores. And even better, a 6-point lift for the stores they converted just in the last year.
So that store refresh is working, but the August bounce, is it sustainable? Or was it mostly back to school timing and that Jordan launch, especially since they're guiding for a dip again in Septoct?
That's the million-dollar question, isn't it? The sequential improvement is definitely positive. Jordan shows they can execute on big brand partnerships. The Flare format success suggests that, yes, investing in the physical store experience can work.
What makes Flare different?
From what we understand, it's more curated, maybe more engaging environment, better merchandising, less purely transactional. Scalability is still a question, but the results so far are encouraging for brick and mortar.
Okay, interesting. And the other side, the brand portfolio. How did that segment hold up?
Sales there were down 3.5%. They pointed to pressure in their more value-oriented brands.
Okay.
And also some order cancellations related to China manufacturing. So another tariff ripple effect potentially.
Right. But wasn't there some strength within that portfolio?
Yes, absolutely. They're designated lead brands. That's Sam Edelman, Allen Edmonds, Naturalizer, Bionic, collectively delivered sales growth.
Ah, okay. So the core brands are doing well.
Right. And those lead brands now make up over 50% of the segment's sales. Sam Edelman, for instance, had strong domestic growth and double-digit international growth.
So they're leaning into those higher margin, maybe more resilient brands.
Exactly. These are generally brands with stronger identity, more direct-to-consumer potential, maybe less exposed to the heavy promotions you see elsewhere. That's where they see the future profitability coming from. And DTC, direct-to-consumer, is strong there, about 75% of the brand portfolio's total sales.
75% DTC in that segment, that's quite high. Okay, so summing up the quarter, tariffs hitting margins, promotions adding pressure, but strategic moves with Stuart Weitzman, cost cuts, and strength in those core lead brands. What does it all mean for the outlook and investor confidence now, especially with that big EPS miss hanging over things?
Well, the big signal was them suspending their annual guidance.
Suspending guidance entirely.
Yeah, citing the continued uncertainty from tariffs. That tells you visibility is really limited right now. And that, understandably, makes the market very nervous.
Yeah, that usually doesn't go over well. Sends a signal of, we just don't know.
Pretty much. It tells investors things are too unpredictable to confidently forecast the full year. Buckle up. Often leads to the stock getting re-rated for higher risk.
Okay, so no full year guidance. What did they say about Q3 specifically? Any hints?
Some specifics. For Famous Footwear, even with that positive August, they expect comps in September and October to be down low single digits.
So that August bounce might have been temporary?
Looks like it, or at least not sustainable at that level immediately. For the brand portfolio, excluding the new Stuart Weitzman piece, they expect gross margin pressure in Q3 to be similar to Q2 levels.
Still tough then.
Yeah, but they are projecting some improvement in Q4. They think mitigation actions like shifting sourcing away from China, some price increases will start to help them.
Okay, some light at the end of the tunnel maybe for Q4 margins.
Yeah.
And costs. SG&A.
Excluding Stuart Weitzman again, they expect a modest increase in SG&A in Q3, but more benefit from the restructuring savings kicking in during Q4.
So a bit of a delayed reaction on the cost savings hitting the bottom line.
Seems that way. So look, management tried to emphasize the positives, right? Improving trends in July, August, the potential of Stuart Weitzman, the cost savings program completed.
But the market wasn't buying it.
The market reaction was clear. That big EPS miss, the ongoing margin pressure from tariffs and promotions, that's what dominated investor sentiment. They need to see execution now, proof that the mitigation is working and margins are expanding again, not just hear about strategic plans.
Execution is key. Okay, that sets the stage perfectly for our This Is Not Financial Advice segment. Investment committee, let's brainstorm. We've got the numbers, the market skepticism, the tariff overhang, management's pitching green shoots, the luxury acquisition cost cuts, DTC. But the street is clearly focused on the near-term pain and that suspended guidance. What are the potential plays here?
All right, here are a couple of ideas. Again, purely hypothetical, not advice.
Absolutely. For discussion only.
First idea. Let's call it the tariff fade, Stuart Weitzman catalyst long.
Okay, sounds optimistic. What's the thesis?
The thesis is the market has hammered this stock, maybe too much. Down 65% year over year before this latest hit. Maybe they've overpriced the tariff impact. The narrative suggests tariff mitigation lags. It's not a permanent state.
Right.
So if those Q4 margin improvements they hinted at actually happen, and if they start showing real synergies from Stuart Weitzman, maybe even signal a clear path to it being accretive in 2026, there could be significant upside from these levels.
And the balance sheet flexibility helps there.
Exactly. That expanded ABL gives them breathing room. This is basically a bet on management executing on controlling what we control, leveraging those lead brands that did grow, and eventually getting past the worst of the tariff impact. And Famous Footwear's August comp turning positive, even briefly, shows there is underlying demand for the right stuff.
Okay, so what's the action? How would you structure that kind of bet?
Go long CL, but maybe structure it carefully, like a calendar spread. Buy some longer-dated, out-of-the-money calls, say January 2026 expiration, maybe $18 or $20 strikes. This gives you time for the turnaround story to play out, for tariff mitigation to show up, for Weitzman details to emerge, perhaps with Q3 results.
Okay, buying time and upside potential, how do you fund it or hedge it?
You could potentially fund part of it by selling shorter-dated puts, maybe slightly in the money puts, like October, $12.50. Capture some premium, benefit if there's any final near-term washout. It's a contrarian play, banking on execution and patience paying off over the current fear.
Interesting structure. A long-term narrative bet against short-term pain. Okay, what's the counter-argument or a hedge?
Idea 2. The Famous Footwear promotional intensity, short or hedge.
All right, focusing on the potential downside, the thesis.
Even though August was positive at Famous Footwear, management explicitly said expect September-October comps to be down low single digits. And remember, part of the Q2 margin hit was more days on promotion, a deeper promotional offer.
Right, the BOGO impact.
Yeah, and while they'll anniversary that specific depth, the whole industry feels like it's in this heightened promotional environment. What if the consumer pulls back even more?
Right.
Or reacts badly to vendor price increases? Famous Footwear could get dragged back into heavy promotions for the holidays.
Hurting margins more than expected, maybe offsetting gains elsewhere?
Exactly. It could dampen any recovery from the brand portfolio side. So the thesis is that the pressure on Famous Footwear's margins might persist or even worsen if the macro sours or promotions stay intense.
So the action for this one?
A couple of ways. You could look for a short position in a competitor, maybe a pure play, lower price footwear retailer that overlaps a lot with Famous Footwear's categories. Or, more directly, a targeted put option strategy on CAL itself. Maybe looking out towards Q4 if you think the environment is weakening and those promotional pressures won't ease up like management hopes.
So it acts as a hedge against that main long idea, especially if the consumer gets more price sensitive.
Precisely. Or if those Famous Footwear margin improvements just don't show up as quickly as planned.
Okay, fascinating ideas. And just to reiterate, for everyone listening,
Please remember, this is purely for discussion, educational purposes. not financial advice.
Definitely not. Always do your own research and due diligence before making any investment decisions.
Absolutely.
Okay, so let's wrap this up. Caleres, a really tough Q2. Tariffs took a big bite out of margins. That EPS miss really shook investors.
Dominated the headlines for sure.
But they're not standing still. They're making big moves. Stuart Weitzman acquisition, cost cuts, focusing on those lead brands in DTC, trying to pivot to higher margin growth.
A clear strategic direction, even if the execution path is bumpy right now.
Right. And guidance is suspended, which tells you uncertainty is still the name of the game. Management sees some improving trends, some strength in core areas.
But a market reaction was negative. They need to deliver now, show that tariff mitigation is working, integrate Stuart Weitzman smoothly, and get those margins expanding again. That's what will restore confidence.
It really sets up this core question going forward. Can they successfully weave a luxury brand like Stuart Weitzman into this bigger, more diverse company while also managing the ongoing pressures, especially at Famous Footwear?
It's a complex balancing act, a fascinating one to watch unfold in the footwear space.
Absolutely. We'd love to hear your thoughts, too. What do you think about Caleres' strategy and where the footwear market is headed? Thanks for tuning in to The Deep Dive.